Welcome back. You're still watching Investment Guide on CNBC TV 18, where we're doing a deep dive into the IT sector. In fact, we have a couple of guests joining in who are telling us how to approach this space despite the rally that we've seen. Mahesh Patil of Aditya Birla Sun Life, AMC, and Rahul Malhotra of Bernstein are speaking with us. So let me just try and drill it down to the specifics. For a viewer watching us right now, Rahul, I want you to answer this question. What are the important financial ratios that one needs to track? I mean, our colleague Rima was just telling us about the key parameters. But from your end, when you pick a company in the IT space, what are the important ratios?
Sure, thanks, Sonia. So I think the key ratios, obviously, growth margins and the balance sheet. And growth, I think, a key factor that a lot of these companies started giving out is their total contract value in a quarter. And that's been a good kind of view of how their ability to win large deals with the clients is evolving. And TCS has been giving out for last few quarters. Infosys gives out that number. And we've seen that growing significantly. TCS was close to 28 billion this year with 8-9 billion the quarter. Infosys large deals also has been expanding. So I think that is one metric that we track quickly, closely to look at how is the deal momentum playing out, because a lot of the growth is driven by large deals. And I think on the growth, revenue growth, as the constant currency, both sequential quarter on quarter and year on year are key factors. We also look at growth by verticals. So constant currency growth across verticals kind of gives out the fact of whether the growth is stronger in one vertical versus the other. It's more balanced growth across banking, financial services, retail, telecom, consumer products. So I think those growth parameters are imperative to look at the quality of growth that's coming out. And I think on the margin side, EBIT percentage margins is important to look at, particularly because that reflects the fact that is a company going through more pricing pressure if margin starts dipping quarter on quarter, or there is more stability where they're using their operating efficiencies of on-site offshore ratios or utilization of fixed price projects to manage their margins. So I think the growth side, the EBIT margin, and finally the free cash flow conversion. How much, because these are high dividend yield businesses, typically free cash flow conversion shows the quality of their balance sheet. So if the free cash flow conversion is close to 90 to 100% of net income, that reflects a fairly strong balance sheet and conversion ratios, which obviously goes down for high ROCs in the business. So I think those 4 or 5 on growth, margins, and then ROC and free cash flow conversion are the key metrics to look at once you look at IT services performance.
Okay, great. That sort of gives investors a benchmark to work with and some of the key ratios to look at. Mahesh, I was doing some studying last night. I was looking at your portfolios, and what I figured were a couple of things. One, that technology is among the top 3 sectors in terms of exposure across most of your funds. I mean, the large cap, even the focused equity. And then I was looking at your Digital India fund, which is managed by Kunal. And surprise, surprise, Apple. You have exposure to Apple. I know you won't get into individual holdings and stocks, but that brings me to a larger question, right? Indians now want to play technology, and they're asking if it's just better to invest in some of these offshore US funds rather than an India-specific IT fund. What would you say to that debate?
Well, that's true, actually. In the last 2-3 years, we started looking at global companies, and more so in the technology space, right? Because that's an area where we've got a lot of these large global companies which are there. And they are, I mean, for the typical IT outsourcing kind of business, I think Indian IT companies actually suit the bill. You can play that too. But there are, I mean, IT is not just towards outsourcing, right? It's much more than that. And there are global companies which are platform companies. There are product companies which are there globally, which we think offer good upside, okay, because they're catering not only the US market, but to the global marketplace, right? And have shown a very steady growth over many years. So I think with that objective and to diversify our positioning, and essentially to play a certain spectrum of the technology space, which you can't really play through our listed space, we decided to look at some of these names. So we have players, companies like Apple, for example, Microsoft, which we have. Again, there are various reasons which we have got into some of these names. Some of these companies are product companies, for consumer-oriented companies, and again, the common theme underlying some of these names are they are the technology leaders in that space. They are innovators in that space, and they are continuously investing their capital into innovation, to R&D, and ensuring that they are coming up with new products, which will enable to sustain the kind of growth what they have shown in the past. So I think that's helped us actually to diversify the portfolio. And while there is still a correlation between domestic IT companies and global IT, in fact, we see that the recent valuation multiple re-rating what we have seen in the domestic names is mainly to do with the rally what we have seen globally. But there are niche companies which are there globally, which are not so much dependent, purely on the outsourcing business. And at times we also see there is a lot of noise which happens, especially during the US elections about outsourcing on visa restrictions. And at that times, it makes sense to really have some exposure to some of the global names, which, while the underlying fundamentals remain the same, I think they're not too much impacted by that. So we've seen this diversification really has helped us, and we have made a beginning over there, but idea is to really have a much larger ownership there, at least around 20% of our portfolio to some of these large leading global IT names.
All right, we're actually running out of time. It's a very enriching conversation, but let's leave our viewers with some IT bets, right? So Rahul, tell us, what are your top IT bets? Which are the companies that you like the most, say from a 1 to 2 year horizon now?
So for us, our top pick is TCS, Tata Consulting Services. And I think from the digital transformation journey that's playing out for all of these companies, I think TCS, because of its full service positioning, a very platform approach, is well positioned to take a lot of share from these large deals coming in. And also TCS has the ability to keep the margins much more steady. They maintain the margin in the 25-26% EBIT range for a longer time. So from our perspective, we like the strength of the business model, the ability to maintain growth and win some of the very strong large deals in the market that will come in the near future as well, and then maintain very strong margins and deliver best-in-class free cash flow. So TCS for us is our top pick.
Okay, all right, gentlemen, we have completely run out of time. Not questions, but time, yes. Thank you very much for being with us and giving us your perspective and some thoughts on all about the IT space and how things are evolving over here. So very, very interesting trends coming in, Sonia, from FANGs in the US to our own homegrown companies. Technology seems to be here to stay in the investment horizon.
And I think we've become wiser, right? We know all the ratios that you need to track. We know all the valuations right now. So it was an IT 101 lesson that we got from both our experts in the last half an hour. With that, it is curtains down on this edition of Investment Guide. We will be back same time, same place next week to talk about a deep dive into another sector. Thanks for watching.